Hello everyone, welcome to the 214th episode of me learning how to trade in Forex. So in the last episode we were going through using interest rate parity to trade Forex. So we finished off the currency carry trades 101, and in the using interest rate parity to trade Forex, interest rate parity is the fundamental equation which governs the relationship between interest rates and the currency exchange rates. The basic premise of interest rate parity is that hedged returns from investing in different currencies should be the same regardless of the level of interest rates. So there's two versions of interest rate parity, covered and uncovered. Forward exchange rates are exchange rates which anticipate the exchange rate at a future point in time. Arbitrage is the simultaneous purchase and sale of an asset in order to profit from the difference in price. So your forward rate is calculated by spot rate times by 1 plus interest rate of the overseas currency divided by 1 plus the interest rate of the domestic currency. A currency with lower interest rates will trade at a forward premium in relation to a currency with high interest rates. So forward rates have very little predictive power of forecasting future interest rates, as forward rates are merely exchange rates adjusted for interest rate differentials. Difference between forward rate and a spot rate is known as the swap points. So if this difference is positive, it's known as a forward premium, and if the difference is negative, it is known as a forward discount. So that's where we got off the last time. Now we're on to, well, I guess we did go through the covered interest rate parity, but it wasn't really clear about what, I guess I wasn't really understanding what it meant last lesson, so try to go through it again now and see if I have any newer understanding. So covered interest rate parity. With covered interest rate parity, forward exchange rates should incorporate the difference in interest rates between two countries. Otherwise, an arbitrage opportunity would exist. Forward exchange rates should incorporate the difference in interest rate between two. In other words, there is no interest rate advantage if an investor borrows in a low interest rate currency to invest in a currency offering a higher interest rate. Typically, the investor would take the following steps: borrow an amount in a currency with low interest rates, convert the borrowed amount into currency with a high interest rate, convert the proceeds in an interest-bearing instrument in this high interest rate currency, simultaneously hedge exchange risk by buying a forward contract to convert the investment proceeds into the first lower interest rate currency. The returns in this case will be the same as those obtained from investing in an interest-bearing instrument in a low interest rate currency. Under the covered interest rate parity condition, the cost of hedging exchange risk negates the higher returns that would occur from investing in a currency that offers high interest rate. Yeah, I still don't understand what this means, so we're just going to skip it now. So the formula for covered interest rate parity is 1 plus ID, which is the interest rate in the domestic currency, or the base currency, is equal to the forward foreign exchange rate over the current spot exchange rate times by 1 plus the interest rate in the foreign currency or the quoted currency. So formula for covered interest rate parity, forward covered covered interest rate parity. So 1 plus the interest rate in the domestic currency, the interest rate in the domestic currency, or the base currency, is equal to F forward foreign exchange rate, the forward foreign exchange rate, the current spot exchange rate, times by 1 plus the interest rate in the foreign currency or the quote currency. In the foreign or the quoted currency. So covered interest rate arbitrage Consider the following example to illustrate covered interest rate parity. Assume that the interest rate for borrowing funds for 1 year period in country A is 3% per annum, and that the 1 year deposit rate in country B is 5%. 1 year deposit rate. Further, assuming that currencies of the two countries are trading at par on the spot market, i.e. currency A equals currency B, investor does the following: borrows in currency A at 3%, converts the borrowed amount to currency B at spot rate, invests these proceeds in a deposit denominated in currency B and paying 5% per annum. So they would overall get 2% profit. Right? The investor can use the 1 year forward rate to eliminate the exchange risk implicit in this transaction, which arises because the investor is now holding currency B, but he has to repay the funds borrowed in currency A. Under covered interest rate parity, the 1 year forward rate should be approximately equal to 1.0194, i.e. currency A equals 1.0194 currency B, according to the formula discussed above. What if the 1 year forward rate is also at a parity, i.e. currency A equals currency B? In this case, the investor in the above scenario would reap risk-free profits of 2%. Yeah. Here's how it works. Assume the investor borrows 100,000 of currency A at 3% at 1 year periods, immediately converts the borrowed proceeds into currency B at spot rate, places the entire amount in a 1 year deposit at 5%, simultaneously enters a 1 year forward contract for the purchase of 103,000 currency A. After 1 year, the investor receives 105,000 of currency B, of which 103,000 is used to purchase currency A under the forward contract and repay the borrowed amount, leaving the investor's pocket the balance, 2,000 of currency B. The transaction is known as a covered interest rate arbitrage. Market forces ensure that forward exchange rates are based on the interest rate differential between two currencies, otherwise arbitrageurs would step in to take advantage of the opportunity for arbitrage profits. In the above example, the 1 year forward rate would therefore necessarily be close to 1.0194. In the example above, the 1 year forward rate would therefore necessarily be close to 1.0194. Uncovered interest rate parity. Uncovered interest rate parity states that the difference in interest rates between two countries equals the expected change in exchange rates between these two countries. Uncovered interest rate parity. Uncovered interest rate parity states that the difference in interest rates between two countries equals the expected change in exchange rates between those two countries. So uncovered interest rate parity states the difference in interest rates between two countries equals the expected change in exchange rates between those two countries. In exchange rates between those two countries. Theoretically, if the interest rate differential between two countries is 3%, then the currency of the nation with the high interest rate would be expected to depreciate 3% against the other currency. In reality, however, it's a different story. Since the introduction of floating exchange rates in the early 1970s, currencies of countries with high interest rates have tended to appreciate rather than depreciate. As the UIP equation states, this well-known conundrum, also termed the forward premium puzzle, has been the subject of several academic research papers. The anomaly may be partly explained by the carry trade, whereby speculators borrowing in low-interest currencies such as the JPY sell the borrowed amount and invest the proceeds into higher-yielding currencies and instruments. The Japanese yen was a favourite target for this activity until mid-2007, with an estimated $1 trillion tied up in yen carry trade by that year. Relentless selling of borrowed currency has the effect of weakening it in the foreign exchange markets. From the beginning of 2005 to mid-2007, the JPY depreciated almost 21% against the USD. The Bank of Japan's target rate over that period ranged from 0% to 0.5%. If the UIP theory had held, then the yen should have appreciated against USD on the basis of Japan's lower interest rates alone. theoretically, if the interest rate differential between two countries is 3%, then the currency of the nation with the higher interest rate would be expected to depreciate 3%, would be expected to depreciate 3% against the other currency. In reality, however, it's a different story. Since the introduction of floating exchange rates in the early 1970s, currencies of countries with high interest rates have tended to appreciate rather than depreciate. In reality, currencies of countries with higher interest rates tends to appreciate rather than depreciate. As the UIP equation states, this well-known conundrum, also termed the forward premium puzzle, has been the subject of several academic research papers. The anomaly may be partly explained by the carry trade, whereby speculators borrow in low-interest currencies such as the JPY, sell the borrowed amount and invest the proceeds into higher-yielding currencies and instruments. The JPY was a favorite target of this activity until mid-2007, with an estimated $1 trillion tied up in the yen carry trade by that year. Relentless selling of the borrowed currency has the effect of weakening it in the foreign exchange markets. From the beginning of 2005 to mid-2007, the JPY depreciated almost 21% against the USD. Bank of Japan's target rate over that period ranged from 0% to 0.5%. If the UIP theory had held, the yen should have appreciated against the USD on the basis of Japan's low interest rates alone. Yep, so the formula for uncovered interest rate parity is uncovered forward rate is equal to spot rate times by 1 plus interest rate in country C. What's country C? Interest rate in country C over interest rate in country B. Which one's C and which one's B? Which one's the high interest rate country? Which one's the low interest rate country? Name them C and B doesn't help that much. But anyways, the interest rate parity relationship between the US and Canada. Let's look at the historical relationship between the interest rates and exchange rates for the United States of Canada. Not United States of Canada, United States and Canada, the world's largest trading partners. The CAD has been exceptionally volatile since the year 2000, after reaching a record low of 61.79 cents in January 2002. It rebounded close to 80% in the following years, reaching a modern day high of more than 1.1 USD in November 2007. Looking at the long-term cycles, the CAD depreciated against the US dollar from 1980 to 1985, appreciated against the USD from 1986 to 1991, and commenced a lengthy slide in 1992. Culminating in its current January 2002 record low. From that low, it then appreciated steadily against the USD for the next 5.5 years. For the sake of simplicity, we'll use prime rates, the rates charged by commercial banks to their best customers, to test the UIP condition between the USD and the CAD from 1988 to 2008. Based on prime rates, UIP held during some points of this period, so uncovered interest rate parity held for some points of this period but did not hold at others, as shown in the following examples. So the Canadian prime rate was higher than the US prime rate from September 1988 to March 1993. During most of this period, the CAD appreciated against its US counterpart, which is contrary to the UIP relationship. So UIP relationship would state that the country with the high interest rate should depreciate in value against the country with the low interest rate. So, however, CAD's prime rate was higher than the US prime rate, but CAD still appreciated against the USD, which is contrary to the UIP relationship. The Canadian prime rate was lower than US prime rate for most of the time from mid-1995 from beginning to the beginning of 2002. As a result, the CAD traded at a forward premium to the USD for much of this period. However, the CAD depreciated 15% against the USD, implying that UIP did not hold during this period as well. So, the weaker currency depreciated when it should have appreciated. So it did not hold during this period as well. The UIP. The UIP condition held for most of the period from 2002 when the CAD commenced its commodity-fueled rally. Until the late 2007 when it reached its peak, the Canadian prime rate was generally below the US prime rate for much of this period, except for an 18-month span from October 2002 to March 2004. The UIP condition held for most of this period from 2002 when the CAD commenced its commodity-fueled rally, until late 2007 when it reached its peak. The Canadian prime rate was generally below the US prime rate for much of this period, except for an 18-month span from October 2002 to March 2004. So this time, CAD appreciated against the USD, even though the Canadian prime rate was generally below the US prime rate for much of this period. Okay, hedging exchange risk. Forward rates can be very useful as a tool for hedging exchange risk. The caveat is that a forward contract is highly inflexible because it is a binding contract that the buyer and the seller are obligated to execute at the agreed upon rates. Understanding exchange risk is an increasingly worthwhile exercise in a world where the best investment opportunities may lie overseas. Consider a US investor who has the foresight to invest in the Canadian equity market at the beginning of 2002. Total returns from Canada's benchmark S&P/TSX equity index from 2002 to August 2008 were 106%, or about 11.5% annually. Compare that performance with that of S&P 500, which has provided returns of only 26% over that period, or 3.5% annually. Understanding exchange risk. Here's a kicker. Because currency moves can magnify investment returns, a US investor invested in the S&P/TSX at the start of 2002 would have had a total returns in terms of USD of 208% by August 2008, or 18.4% annually. The CAD's appreciation against the USD over that time frame turned decent returns into spectacular ones. Of course, at the beginning of 2002, with the CAD heading for a record low against the USD, some US investors may have felt the need to hedge their exchange risk. In that case, they have been fully hedged over the period mentioned above. In that case, if they had been fully hedged over the period mentioned above, they would have foregone the additional 102% gains arising from the CAD's appreciation. With the benefit of hindsight, the prudent move in this case would have been not to hedge the exchange risk. However, it is an altogether different story for Canadian investors invested in the US equity market. In this case, the 26% returns provided by the S&P 500 from 2002 to August 2008 would have turned to negative 16% due to the USD's depreciation against the CAD. Hedging exchange risk, again with the benefit of hindsight in this case, would have mitigated at least part of that dismal performance. Understanding exchange risk is increasingly worthwhile exercise in a world where best investment opportunities may lie overseas. Okay, Bottom line, interest rate parity is fundamental knowledge for traders of foreign invested currencies. In order to fully understand the two kinds of interest rate parity, however, the trader must first grasp the basics of forward exchange rates and hedging strategies. Armed with this knowledge, the Forex trader will then be able to use interest rate differentials to his or her advantage. The case of USD/CAD appreciation and depreciation illustrates how profitable these trades can be given the right circumstances, strategy and knowledge. Understanding exchange risk is increasingly worthwhile, so need to understand exchange risk. Okay. Next up, harmonic patterns in FX. Harmonic patterns in the currency markets. Harmonic price patterns are those that take geometric price patterns to the next level by utilizing Fibonacci numbers to define precise turning points. Harmonic price patterns utilize Fibonacci numbers to define precise turning points. Unlike other more common trading methods, harmonic trading attempts to predict future movements. Let's look at some examples of how harmonic price patterns are used to trade currencies in the Forex market. So, key takeaways. Harmonic trading refers to the idea that trends are harmonic phenomena, meaning they can subdivide into smaller or larger waves that may predict price direction. Harmonic trading relies on Fibonacci numbers, which are used to create technical indicators. Fibonacci sequence of numbers starting with 0 and 1 is created by adding the previous two numbers, so 0, 1 is 1, 1 plus 1 is 2, 1 plus 2 is 3, 3 plus 5 is 8, so on. This sequence can then be broken down into ratios, which some believe provide clues as to where a given financial market would move to. The Gottlieb, Bat, and Crab are one of the most popular harmonic patterns available to technical traders. Met these before, Gottlieb, Bat, and Crab. Right, okay, so geometry and Fibonacci numbers. Harmonic trading combines patterns and maths into a trading method that is precise and based on the premise that patterns repeat themselves. Harmonic trading is based on the premise that patterns repeat themselves. At the root of the methodology is a primary ratio or some derivative of it, so 0.618 or 1.618. Complementing ratios include 0.382, 0.5, 1.412, 2.24, 2.618, 3.14, and 3.618. Primary ratio is found in almost all natural and environmental structures and events. It is also found in man-made structures. Since the pattern repeats throughout nature and within society, the ratio is also seen in the financial markets, which are affected by the environments and societies in which they trade. So, primary ratio, complementing ratio. So, by finding patterns of varying length and magnitudes, the trader can then apply Fibonacci ratios to the patterns and try to predict future movements. The trading method is largely attributed to Scott Carney, although others have contributed or found patterns at levels that enhance performance. The primary ratio can be found in the financial markets. By finding patterns or varying lengths of magnitudes, the trader can then apply Fibonacci ratios to the patterns and try to predict future movements. The trading method is largely attributed to Scott Carney, although others have contributed or found patterns at levels that enhance performance. Okay, so issues with harmonics. Harmonic price patterns are precise, requiring the pattern to show movements of a particular magnitude in order for the unfolding of the pattern to provide an accurate reversal point. Harmonic price patterns are precise and requires the pattern to show movements of a particular scale, of a particular magnitude for the unfolding of the pattern. For the unfolding of the pattern to provide an accurate reversal point. A trader may often see a pattern that looks like a harmonic pattern, but the Fibonacci levels would not align to the pattern, thus rendering the pattern unreliable in terms of the harmonic approach. This can be an advantage as it requires the trader to be patient and wait for the ideal setup. If a pattern looks like a harmonic pattern, but the Fibonacci levels doesn't align, then the pattern is unreliable in terms of the harmonic approach. Then the pattern is unreliable in terms of harmonic approach. The harmonic approach in terms of the harmonic approach. Harmonic patterns can gauge how long current moves will last, but they can also be used to isolate reversal points. So harmonic patterns can be used to gauge how long current moves will last, how long current moves will last, but they can also be used to isolate reversal points and also to isolate reversal points. The danger occurs when a trader takes position in the reversal area and the pattern fails. When this happens, the trader can be caught in a trade where the trend rapidly extends against them. Therefore, as with all trading strategies, risk must be controlled, so stop losses. It is important to note that patterns may exist within other patterns, and it is also possible that non-harmonic patterns may and likely will exist within the context of harmonic patterns. Also possible that non-harmonic patterns exist within the context of harmonic patterns. These can be used to aid in the effectiveness of the harmonic pattern and enhance entry and exit performance. Several price waves may also exist within a single harmonic wave, for instance, a CD wave or AB wave. Prices are constantly gyrating, therefore it is important to focus on the bigger picture of the time frame being traded. The fractal nature of the markets allows the theory to be applied from the smallest to largest time frames. So I think, remember looking at the fractal word, it's like the same, that the pattern repeats in itself. So to use this method, the trader will benefit from a chart platform that allows them to plot multiple Fibonacci retracements to measure each wave. Patterns may exist in other patterns, and it's also possible that non-harmonic patterns may and likely will exist within the context of harmonic patterns. Non-harmonic patterns can exist within the context of harmonic patterns. These can be used to aid in the effectiveness of the harmonic pattern and enhance the entry and exit performance. Several price waves may also exist within a single harmonic wave. So several price waves can also exist within a single harmonic wave. For instance, a CD wave or AB wave. Prices are constantly gyrating, therefore it's important to focus on the bigger picture of the time frame being traded. Are constantly gyrating, so focus on the bigger picture of the time frame being traded. Fractal nature of the market allows the theory to be applied from the smallest to largest time frames. To use this method, the trader will benefit from a chart platform that allows them to plot multiple Fibonacci retracements to measure each wave. Prices are constantly gyrating, move in a circle. So that means it goes up and down, right? Up and down. Okay, types of harmonic patterns. There is quite an assortment of harmonic patterns, although there are 4 that seem most popular. These are the Gartley, butterfly, bat and crab patterns. So 4 popular harmonic price patterns. Gartley, butterfly, bat and crab. The Gartley was originally published by H.M. Gartley in his book Profits in the Stock Market, and the Fibonacci levels were later added by Scott Carney in his book The Harmonic Trader. The levels discussed below are from that book. Over the years, some other traders have come up with some other common ratios. When relevant, those are mentioned as well. Bullish Gartley, bearish Gartley. A, B, C, D, X, A, B, C, D, X. I would have thought these were the other way around because bullish is going up, but it looks like this one's going down, so A, B, C, D. Whereas a bearish seems going up, so A, B, C, D. Okay. The bullish pattern is often seen early in a trend, and it is a sign that the corrective waves are ending and an upward move will ensue following points D. All patterns may be within the context of a broader trend or range, and traders must be aware of that. So this is the Gartley, bullish Gartley. Often seen early in the trend, so often seen early in a trend, and it is a sign that the corrective waves are ending and an upward move will ensue the following points D. So, and it's a sign that the corrective wave is corrective waves are ending and an upward move will ensue following points D. All patterns may be within the context of a broader trend or range, and traders must be aware of that. So all patterns may be within the context of a broader range, of a broader trend or range. All patterns may be within the context of a broader trend or range. All patterns may be within the context of a broader trend or range, and traders must be aware of that. It's a lot of information to absorb, but this is how to read the chart. We will use the bullish example, so this one here. The price moves up to A, so whoop goes up here. It then corrects, and B is a 0.616 retracement of wave A. The price moves up via BC and is a 0.382 to 0.886 retracement of AB. The next move is down via CD, and it is an extension of 1.13 to 1.618 of AB. Point D is a 0.786 retracement of XA. Many traders look for CD to extend 1.27 to 1.618 of AB. The area at D is known as a potential reversal zone. The area at D is known as a potential reversal zone. This is where long positions could be entered. Where long positions could be entered. Alright, so after this, it'll give you the direction here. Right, okay, so after this it should be bullish, and after this it should be bearish. Although waiting for some confirmation of the price starting to rise is encouraged, could be entered after waiting for confirmation of the confirmation of price starting to rise. Is encouraged. A stop loss is placed not far below entry, although additional stop loss tactics are discussed in a later section. Stop loss can be placed not far below entry, although additional stop loss tactics are discussed in a later section. For the bearish pattern, look to short trade at D with the stop loss not far above. Fibonacci retracements moves at A. Retracement isn't actually the distance, is it? Retracement of B. So when I say retracements, does that mean it's the distance from A to C? So A to C would be equal to 0.886. What is this I here? What's I? Oh no, that's not I, that's a was it semicolon? So 0.382 or 0.886, right, okay. Retracement 67.1% or BC of AB. Yeah, so it is the distance pretty much. So cool, so it's just the distance. Yeah, okay. So for bearish patterns, look to short trade at near D with a stop loss not too far above. So opposite of the bullish Gartley. I think I'm going to leave this episode here. In the next video, I'm going to reread through the Gartley again, just to be double sure on that. Bye bye.